This is Matt Godleski with CapTrust Advisors bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Stocks hover near all-time highs as inflation pressures are mounting, and investors ask, when will the Fed act? Equity markets were flat this week as investors awaited the U.S. non-farm payrolls report Friday. Bond yields have been stable in the face of rising inflation pressures, with investor demand for safe assets continuing to suppress interest rates. The Fed's Beige Book survey released this week showed a strong recovery is in place. Price pressures are showing up as employers face worker shortages and rising input costs. Many businesses reported plans to pass along their higher costs to customers, a worrying sign of consumer price increases ahead. Positive news on the employment picture raises the stakes for the Fed. Less than 400,000 Americans filed for unemployment in the last week of May, and an ADP report showed an increase of almost 1 million jobs last month, exceeding expectations. U.S. service providers also expanded at the fastest pace on record dating back to 1997. Many investors are concerned that markets have not priced in the real threat of inflation. Bottlenecks continue to strain supply chains, and overwhelming demand is stressing producers' abilities. Inventories are also already at very low levels, with price pressures building. Adding to concerns, the fact that many investors today have never experienced any meaningful level of inflation, as the past 30 years have been marked by declines in inflation. If inflation becomes embedded in expectations and is not transitory, as the Fed suggests, policymakers may have to take swift action to get inflation under control. The Fed remains adamant that prices will remain stable for the medium term, and they continue to focus on pushing the accelerator to foster growth and increase employment across the economy. China has become a powerful influence in global prices over the last several decades as the manufacturers of the world economy, using low-cost labor to supply cheap goods. That is now changing as China's labor force shrinks and their currency appreciates. China may now in fact be exporting inflation instead of disinflation, reversing the environment that policymakers have worked in for the past several business cycles. Further forcing the Fed's hand, higher debt burdens will require some coordination between fiscal and monetary authorities to keep borrowing costs sustainable over time. Given the Fed's history of reluctance in reducing their support, we see the yield curve continuing to steepen, with short-term rates anchored lower and longer-term yields set to rise. The impact this will have across asset classes is meaningful. Fixed income will continue to face pressure as short-dated bonds yield nothing, and inflation erodes the value of longer-dated interest payments. Equity should continue to find support through relative valuation and increasing profits, though leadership will likely be different than seen over the last decade. We believe growth stocks that have dominated market returns since 2008 will continue to fall out of favor as investors shift to companies that represent better value in a higher rate world. As always, we remain focused on changing market dynamics and make changes only when appropriate. Thanks for watching, and check out our website to read the full version of The Pulse for more details.